You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here with episode number 137 of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guests for this week's show are multifamily investment experts and fellow real estate podcasters, Jake Stenziano and Gino Barbaro. In today's show, we're going to be speaking with Jake and Gino about how they got their start as multifamily investors and how they've been able to amass a portfolio worth in excess of $32 million in just a few short years. In our candid conversation, we'll also discuss the various challenges that they faced when getting started in this business and how they are able to push through them even in the most difficult of times. And here's what you're going to learn in this show. You're going to learn what attracted Jake and Gino to the Knoxville, Tennessee market and why they decided to turn their focus away from the New York market that they were currently in. You're also going to learn about the power behind finding a coach and a mentor and how this catapulted them forward into their multifamily business. You'll learn why they love mom and pop owned apartment buildings and what unique opportunities these types of properties offer them as investors. You'll learn how they negotiated very attractive owner financing terms on their very first 25-unit deal. You're going to learn what value add components they look for when seeking out multifamily properties to purchase. You're also going to learn about the power of a credibility book and how to create one for your very own business. You're going to learn about the importance of the market itself and why becoming a market expert needs to be your number one priority and finding deals your number two. You're going to learn about Gino's technique on how to read one book per week. That one's actually a pretty exciting one. And trying to think about reading one book per week, how your life would change for the better if you could actually consume one book per week. So he's going to tell you how to do that and much, much more. And guys, if this is the first time you're tuning in the show here, I want to welcome you to our awesome family that we have here at the Real Estate Investing for Cash Flow podcast. If you're one of the many thousands of loyal listeners who make listening to our show a part of their weekly ritual, then I want to welcome you back and thank you from the bottom of my heart for being a part of our family that we have here, because I wouldn't be here if it wasn't for you. So thank you to all of you who tune in each and every week. And if you love what we're doing here and you haven't done so already, please, I kindly ask you, go over to iTunes to leave a 5-star rating and review. It really helps us grow the show. It also helps us attract awesome guests to the show, okay? So go over to iTunes, leave that review, and I'd be grateful forever if you did. And just a few laundry list items I'd like to run through before we get on to the show with Jake and Gino. The first one is the free 30-minute phone call that I offer. Been offering now for a number of years. This is where you and I could connect for 30 minutes, free of charge, no ulterior motives. I won't try to pitch anything. We can talk about whatever your heart desires about real estate investing, okay? So to schedule this 30-minute call with me, go to my website, kevinbuck.com. On the right-hand side, scroll down about 3/4 of the way, and you will see a button that says Schedule a Call with Kevin. Go ahead and click on that. It will take in my calendar, and you can pick a time that best works for you. Also, I do run another podcast. In case you don't know, I am into mobile home park investing. That's what I've been doing now for a number of years. And I do run a weekly podcast show on mobile home park investing. That's all we talk about is mobile home park investing. And you can find that by going to iTunes and searching either my name or searching out mobile home park investing. You'll find it either way. I do it with my business partner, Charles Dehart. And I can tell you that even if you have no interest in mobile home parks, this show will bring you a ton of value because a lot of the techniques and strategies we talk about there are very applicable to just about any other type of real estate investing, okay? So you can go check that out. You can also check out our website, mobilehomeparkacademy.com. You can listen to the episodes on there as well. Just a ton of information. It's a very granular show, meaning that we go really deep into specific topics. We talk about direct mail marketing. We talk about cold calling. We talk about due diligence. We talk about getting financing, raising capital. I mean, kind of A to Z, okay? And again, all these techniques that we discuss on the show are applicable to any other type of real estate, okay? So go check that out. Another thing I want to mention here is that, as you guys probably know, just if you listen to the show on a regular basis, me and my team, we stay very, very busy with acquisitions, and we currently have a few opportunities in contract. In fact, we've got 5 properties right now in contract, a couple other ones in the pipeline, so we're very active. It's turning into be a very, very exciting 2017. Lots of deals happening, lots of things taking place, and we're always looking for potential partners to work with, okay? And so if you're someone that might have an interest in potentially partnering with us on an upcoming deal, shoot us an email to partner@mobilehomeparkacademy.com. Again, partner@mobilehomeparkacademy.com. And these are mobile home parks. We're always looking for potential partners to work with. And so if you might have an interest in working with us, shoot that email. And what will happen is it's an autoresponder email. And so almost immediately you'll get an email back that will actually have a link. I believe there's an opportunity on there right now. It's one of the deals we have in contract, but we have multiple others in contract as well. And so there's also, but here's the important thing. In that email link that you'll get back, there's a calendar link in there, okay? And so if you have an interest in actually talking with Charles and myself about investing in some mobile home parks together, use that calendar link, schedule time to get on the phone with us, and let's talk, okay? Let's see if it might be a good fit for us to potentially work together. And last but not least here is I'm based in Clearwater, Florida, which is in the Tampa Bay area. If you're in town, if you're visiting, work, pleasure, whatever it might be, look me up. I would love to meet with you. I love just meeting with others that are in this business, and would love to hook up with you. Coffee, beer, whatever it might be, whatever you have time for. Shoot me an email directly. My personal email address is kevin@kevinbupp.com. And just let me know when you're going to be visiting, and we will try to coordinate a time during your visit here, okay? So now let's get on to the part of the show that you've been waiting for, which is our interview with Jake and Gino. So here we go. Ladies and gentlemen, today on the show, we are thrilled to be joined by multifamily experts and best-selling authors Jake Stenziano and Gino Barbaro. Both Jake and Gino are just two regular guys that grew up in a small town in western New York who, in just a few short years, have amassed a portfolio of 675 multifamily units valued in excess of $32 million. In addition to their daily real estate business, Jake and Gino also host a popular real estate podcast called Wheelbarrow Profits, which is a must listen if you're at all interested in the multifamily real estate business. So without further ado, let's welcome Jake and Gino to the show. How you guys doing today?
Morning, doing awesome, Kevin. How's it going?
I'm doing fantastic. And just to give our listeners a sense of geography, where are both of you based out of? Because you're not in the same area anymore. So give our listeners a little idea where you're at today.
Sure. This is Jake, and I am in Knoxville, Tennessee, Eastern Tennessee, and living right here, living the dream.
And this is Gino, and I'm floating around in Florida right now. I'm from New York, but I'm down here in Florida. I want to relocate down here because this is where everyone's coming, and I know why now, because it's such an awesome place to live.
Yeah,
Gino's a nomad.
And a great place to invest, right?
Yeah, it is. It's an emerging market. I mean, what's going on in Jacksonville right now is just amazing. The jobs coming down here. The quality of life is great. It just blows New York away. I'm sorry to say, I love New York. I've been there. I'm going to be 46 years old. I've been there my whole life. But I think just the opportunity down here, the quality of living, the quality of life, the cost of living is just everything is just so much better than New York. So yep. I'm here.
Yeah, and you don't have those 6 months of cold, dreary, gray skies in the wintertime.
Nope, not at all.
Yeah, well, good deal, guys. Well, I'm excited that you've joined me here today. And, you guys have such an interesting story because you both come from such different backgrounds in the corporate world. And you've only been at this a few short years, but yet you've amassed quite a large portfolio of multifamily units. And so what I'd really like to do here in the beginning is just have each one of you just take a minute and tell our listeners a little bit more about your background and really how you guys got started in this business.
Yeah, sure. So this is Jake again, and I started off as a pharmaceutical rep. I was working in Westchester County, New York, and I always wanted to do more. At the time, I had this doctor, and I always love giving shout outs to Dr. Neshwat. He's a gentleman who's he's a physician. I used to call on him for work, but he's got real estate. He owns properties from all the way from Daytona Beach in Florida. He's got a condo or a couple condos down there, all the way up to the Canadian border. So he's got real estate everywhere, investment properties. And I would be doing lunches with him, for my job, and he'd just be mentoring me because I think he saw that I was an ambitious young guy, and he was saying, you gotta start investing in real estate. And his whole advice to me was buy a duplex, rent out half of it, and live in the other half rent free. And that's what he did. So he was probably the first person that really got the real estate bug going in me. In 2011, I decided to make a lateral transfer from New York to Knoxville, Tennessee, because I just wanted a better quality of lifestyle, a lower cost of living. Knoxville has no state income tax. The property taxes are extremely low, and I was able to make the same at my corporate job that I was making in New York in Knoxville. So it was a huge swing for me. the day before I left, I used to go into Gino's restaurant all the time, and I would call that Cheers. I would go in, have lunch, and hang out. His brother did a lot of catering with me. I was friendly with Gino, and before I left, I just mentioned to him that I wanted to invest. I was moving to Knoxville. He literally got the laptop out right then and there. We started looking at deals, and I think the light bulb really went off for Gino when he saw the difference in price per unit in Knoxville versus New York, and he said, "Wow, I think there's a real opportunity here because the cap rates are so down in New York." So fast forward to beginning of 2012, we were just hammering, brokers trying to get creative financing, put in owner financing offers, and we got a ton of rejection. We actually had this one broker in this really thick accent, "Y'all never gonna do business down here." And I'm like, "Man, what am I doing wrong? I just want to get a deal that cash flows. Okay, I just want to make some money. I don't want to put money into something that's gonna not make a return." And so we were just networking with the wrong people in the beginning. Eventually, we found a broker who was really like the multifamily guy for the area, and he got us into our first deal. It was 25 units. We got in with 10% owner financing, and from that point, it took us about 2 years to get into our first deal, but it was off to the races, and we haven't looked back.
Okay, exciting. I really want to learn about that first deal. Before we do that, Gino, give us a little bit of your background, because you weren't a legal drug dealer like Jake was.
Street legal, bro. All right.
Yeah. So you owned the restaurant then. You were in the restaurant business. Was it a family business?
It was. I got out of college in '92, so I'm dating myself. Went to work for AIG in reinsurance accounting. One of the most boring jobs you'll ever do. I always tell people watching paint dry is much more fun than reinsurance accounting. But at the time, there was no jobs out there, so I was fortunate to have a job. So my dad had the restaurant in '92. I just got out and went to work with him. We opened up a small place, and I had the place for 20 years. And ups and downs. It was a great business until 2008, 2009. It fed 3 families. It was great. And then once the Great Recession came, a lot of that profitability came out. Internet starts coming on. My brother did not want to start doing Facebook and all social media, so that definitely took a hit on us. So I said to him, I've got to do something. I got 6 kids now, so I had to feed a really big family. I'm saying to myself, how can I do this in New York? And I always tell people this: if you're going to get into real estate or into any endeavor, your should has to become a must. So at that point, around 2009. 2010, my should became the must. So I've been doing this for 5 or 6 years. I took massive action. That's what you got to do. I took massive action by getting coached. I spent a lot of money on coaching with the real estate mentor, and I think coaching really helped Jake and I, because I was the one who came in the beginning. Jake had very little experience. I had more of the experience, and we took it together, and I think that's what really catapulted us. I just didn't go out and buy my first 25 unit deal. I had been buying property in New York back in 2002. I purchased my first 3-family house. Still have that property. I purchased a commercial property in 2007, which I wish I didn't have purchased, but at the same time, that problem has turned into a massive opportunity for me, because I learned from that mistake. Mm-hmm. If you're going to make a big mistake, at least learn from it. So I learned a lot of little caveats, which I'll share with you later. Learning the market, learning the business, focusing on the numbers, all that stuff I learned from that one big mistake. And instead of saying, "Oh, woe was me," I just picked it up. I said, I've got to learn. So that's when I started coaching, and that really catapulted me, really helped me out. And I started looking at deals differently. And that once 2010 came around, I said, let me buy something in Rochester, New York. Don't ask me why. My coach said the cash flow is great up there, and it does. The problem is, when you buy a house for $30,000, 10 years later, the house is worth maybe $30,500. So there's no appreciation, which is fine. There's no appreciation, but at least you're cash flowing. You get a portfolio of 30 or 40 of those houses, you're financially free. Then you can do whatever you want. And that's what my goal was to do. But I said, you know what? I didn't like that. I liked the model, but I didn't at the same time. And then that's when I met Jake, and I started looking at those numbers. And like he said, you can buy a property for $30,000 a unit and get $600 a month in rent. I'm like, wow, you cannot do anything near that in New York. So I was really drawn to that. And, it took us a good 12 to 18 months once he got down there to start looking at deals. And, like Jake likes to say, he blew his seed money. We started investing. He blew his seed money.
That sounds kind of X-rated. Careful, bro.
Yeah, it does sound X-rated, yeah.
He blew it up at the house. Yeah. He bought a house with the wife, and that threw us back a couple months. But you know what? Jake always like to say he's persistent, and I was persistent also. I just wanted to get out of the restaurant business. I wanted to create the lifestyle, because Kevin, real estate can create a lifestyle for you. you can put in the work the first 2, 3, 4 years, really kill yourself. But then after that, you can create your own lifestyle. And with the restaurant, I couldn't do that. I had to work on the weekends. I had to work during the holidays. And, one thing the restaurant did is it gave me the ability to work hard. So when I've got to do, hard work, it's not a problem for me. But at the same time, I just wanted to create that lifestyle with real estate.
Yeah. I mean, in a restaurant business, I'm assuming that if you're not there, the restaurant doesn't make money, right? And so it's probably very difficult for you to step away and take weeks vacations if you so chose to, because really the restaurant, it couldn't survive with you gone for an extended period of time. Is that a correct statement?
That is correct. I have my brother and my mom were both partners, but at the same time, I can go away for a week, and you have that sort of complex where you don't want to leave for 2 or 3 weeks because he's there by himself. So I don't want to put that all on him at the same time. But I said to myself, you're absolutely right. When you're not there, you're not making money. I couldn't build systems. I wasn't able to build systems in the restaurant because it's sort of a different kind of animal than real estate. It's more customer driven, it's more food driven, so you've really got to be there really on top of it. So I said to myself, I can't build a business with restaurant, but I know with real estate we can scale up and build a really fantastic business.
Okay. And so both of you guys, just to clarify, both of you guys had mentors. I mean, in some capacity or another. Gino, you actually went out and paid for coaching. Jake, it sounded like you had a client or one of your doctors that you serviced in your medical.
Yeah, no, this is a great segue into something I wanted to say, because I had people that were promoting the idea of investing in real estate to me. I had even managers within the pharmaceutical company that had rental houses and things like that, and they're like, oh, you should do this, you should look at it. And so I had people that were kind of nudging me. I think the universe was kind of nudging me this way, but then I didn't have any other mentor except for Gino. And so Gino went out there and got the education, and I always like to say education times action equals results. And Gino had that education. We partnered up, and I have my biggest asset is I'm just a maniac. I got a ton of energy. Okay, so I will go out, kick down doors, and just make it happen. So we kind of paired that together, that education, that action, and we've been able to really blow it up since then.
Okay, fantastic.
Kevin, I'm a big proponent of Tony Robbins, and what he says is, if you want to do something, find somebody who's doing it and copy them. And if you want to shorten your learning curve, pay for it. I went to coaching school too. I became a certified professional coach 2 years ago. I wanted to learn how to coach people. So how do I do that? You go to school and you find someone who's doing it. And people are afraid to spend money. To me, it's mind-boggling that they go to college for 4 years, and then when you see a real estate guy, they don't want to spend $3,000 on a weekend. You're spending money on yourself. That education is for yourself. So whatever you're putting into yourself, and you're following people who are doing it. At least if you go to somebody's seminar, make sure they're in the business. You want to follow what they're doing because they've been successful. And that's the difference between people who are really successful and people who aren't. They're not afraid to commit that. And it's you got to have skin in the game. If you don't have money or capital or time invested into it, you're not going to proceed forward. So find somebody who's doing it. They've got a recipe, follow the recipe, and I guarantee you'll be successful.
Yep, Gino, I 100% agree with you. Yeah, it does always blow my mind when those that are looking to get into this business aren't willing to spend a little bit of money to get the proper education. I mean, you can learn a lot online nowadays. I mean, there's websites like biggerpockets.com, and there's podcasts like your podcast and my podcast, and hundreds of others out there that you can get a lot of great free content, but a lot of times it's just not enough. I wouldn't say that there's enough free information out there to where you could go comfortably buy a 150 unit apartment complex without having any background or experience as a real estate investor, and doing it without a lot of risk, right? I mean, would you agree with that statement?
I totally agree with that. I love Bigger Pockets. I'm on there all the time. Yeah. I am actually contributed to them. I love writing articles for them. They've got awesome content. But the thing is, to take it to that next level, a lot of the stuff that I write, I can't get into depth into that. I can't give you my calculator on how to analyze a deal. If you want that, and that's the crux of it. People are always asking questions. How do you analyze a deal? To take a look at a deal in the very beginning, it might take you an hour to look at the whole specifics of a deal. So you really need a coach or a mentor to actually walk you through that. Do you need that for the next 10 years? No, but you might need that for the first year of your education. Yep. And that your learning curve is going to be cut drastically. You're going to make less mistakes. You're going to be able to learn how to actually analyze a deal a lot quicker. You're going to learn how to analyze more deals and learn how to analyze them properly, so you can make a lot less mistakes. So to me, it's crazy that if you're out there and you're seriously considering this business, find somebody who's doing it. Whether you want to pay somebody or like Jake and me, we hooked up together and we did it together.
Yep.
The funny thing about all this is people out there every day dropping $100,000 on an art history degree that they're never going to be able to make, $40,000 with. Yeah. And we're talking about, serious actionable education that can change your life. And it's like, I don't know. It's like it's funny.
I know. So. Yeah, you're not willing to spend $5,000 on an education to go buy $1 million property. Well, then I can't help you. Then I wish you the best of luck. So I want to talk to you guys about. I want to talk about your first deal because it took you guys a little bit of time to actually find that first opportunity. I think you said it was a 25-unit apartment in the Knoxville area, and so. I always feel like we learn so much from our first deals, right? I mean, it's literally you guys looked for quite a long time. You made a lot of offers. You told brokers that there's no way you were ever going to be able to do business with them because of these crazy offers you were putting in.
No, that's what they're telling us.
Well, that's what I meant. That's what they were telling you guys that you're never going to buy a property in this market. Making offers like that. Well, tell us exactly how you guys found that first opportunity, that 25-unit building, and to give us some of the details on it. What you purchased it for, what was the opportunity that you guys saw on that particular property, and then how's it worked out for you today?
Yeah, the deal was really interesting because it sat on LoopNet for almost 2 years. Good old LoopNet,
yep.
And then Gino was alluding to the fact that I blew all my down payment money on a house because we were looking, nothing was happening. So my wife was nudging me. She hates it when I talk about this, but she's like, "I want to buy a house. Because we were living in an apartment. And so finally, we found this really great house. And it was a really good deal. We closed on it, extremely quickly. It was like the first day it was on the market or something. So then it looks like Jake and Gino's real estate dreams are done, right? We're not going to do it. It's over. Well, so my whole thing is working 40 hours a week for the pharmaceutical company. I was in the vaccine division at that time. I was bored. I was like, I want to do more. I can do more. I can't just do 40 hours a week. It just wasn't who I am. So I think it was like a month or two after we closed in the house, I started looking at deals again. And we find this one on LoopNet. It's been sitting around forever. I sent it over to Gino. I said, something's not right here because these numbers actually work. And everything else we were looking at, the numbers didn't work. So we started to pursue it, and we were trying to figure out how we're going to get the money for this. He had the money. I didn't. So I was actually able to take a loan out against my 401k. And that's what was able to get me into this deal. But so we went and looked at it. It was a nightmare. I a lot of times call it the crack den because it was all these little cottages, it was duplexes, quadplexes making up these 25 units, and the owners were an old mom and pop couple, and they didn't do applications, and they basically took cash. Mm-hmm. So if you showed up with the money, they were letting you in the door, all utilities paid, and but they were doing it. There was a demand for that because of the type of people that wanted to get in there. Mm-hmm. So that was the only thing really out there for us, and so we started negotiating price with the broker a little bit, and said, you think they'd hold some paper for us? And he said, yeah, I think we can get that done. Whereas in the past, we would ask questions like that, and people would look at us like we had 12 heads or something. Like, you can't do that. But this guy actually was in the business. He was a multifamily broker. He owned multifamily properties, so he was able to get that done. So we put down 10%. They held 10% of the down payment. I got this little story to tell. It's a little PG-13, maybe R-rated, but when we were going through, they had commingled funds for other multifamily properties they had around town. So we couldn't really, when we were trying to look at their P&L, they didn't really have anything that helped us, and we were trying to figure out how much are these people actually paying every month. Mm-hmm. We went around door knocking. Door to door, saying, making sure that there's a live body in there and verifying the rent. And this is what we did back then. And we get to this one unit, and this guy comes to the door, and he had a hole in his boxers like the size of a basketball, and it was all out there for the world to see. And this poor little 6-year-old lady is walking me around trying to keep a straight face. And I said, okay, I think we're good here. We walked away from that one and just kept going. And it was like, it was just bad. There was definitely people doing drugs there and not paying. So we ended up closing on that one. We got into it and learned very quickly how the eviction process works, which is great in Tennessee. It's 14 days. And we're able to really get a lot of the riffraff out, started doing tenant applications, and we started building a business out from that point. And it was great. The mail lady, the one thing we never forget is the mail lady thanked us 6 months into it because she used to be afraid to go and deliver the mail. And we put a whole new little mailbox row in and clean the place up. So we really started to change that community around. It was in a decent area. It was just they were not doing the things that they were supposed to be doing to run a good business.
Okay,
Kevin, I have a little different perspective perspective on the property. When I first
I'm sorry, I threw it all out there.
So you must not have, Gino, you must not have seen the guy at the homeowners boxers, then, did you? You have a different perspective.
I have a couple horror stories about it also, but when I first saw it, I was actually doing a lot of reading. I'm a voracious reader. I was reading a guy called Fixer Jay DeSima. Fixer Jay likes these kinds of properties, and I said, this is a great property for us. Deferred maintenance. There's no systems in place. Motivated sellers. I just saw owner financing every day of the week. I said, this property is great. I fell in love at first sight. I said, this is going to make us a ton of money because tenants love to have cottages. They love to have their own little space to live in. And in mobile home park, it's the same kind of thing. They have their own space. I said, this property is going to be easy to rent. What value adds did I see? They were weekly renters. I said, Jake, if we put these people onto monthly, we'll get better renters. We're going to make a ton of money. The value adds that were there, I said, these people are paying for cable. Let's knock off the cable bill. The
owners were.
Yeah, the owners were. So $6,000 a year in cable expense that we totally eliminated. They're paying, I don't know, what were they paying for garbage? All their expenses were just completely out of control. So I said, these are all value adds that people didn't factor in when they were buying it. And I said, listen, there's storage sheds on there that have garbage. Let's clean them out. Let's rent them out. So we got $50 a month for another couple storage units on there, 3 or 4 storage units. So I just saw the total possibilities without actually being inundated and seeing the property. Was it hard? Obviously, it was difficult for us in the first 6 months because we didn't know how to handle the tenants. We didn't know how to do tenant evictions. We didn't know how to do applications and all that kind of stuff. That was a whole learning curve for us. Was it hard when one of our tenants actually passed out and died in one of the apartments? We didn't know how to handle that. I mean, it was a lot of bumps in the road, but I think that first deal gave us the momentum and the wherewithal to say this is a viable business. I always make the joke when Jake was going around collecting the rent, he had all this cash and he's like, dude, I got all this cash. He's like a kid in a candy store because, when you're a W-2 employee, you get a paycheck, but now people are paying you. So I think that was the hook for Jake. I think that Jake saw that, people are paying you to live in your place. So there's such an opportunity there. And, you have control of your own life now. I think Jake really throve and really, fed off of that to say, listen, I can control my life. Mm-hmm. Harder I work, the more money I make. And Jake always says that capitalism is great. You want to create more value. You want to work harder. You can make more money in this economy. Mm-hmm.
Yeah, it sounds like you guys, with that first deal, you really put both your feet in the fire. I mean, what you just told me there, Gino, there are a lot of lessons that were learned in that first property. And I've done properties just like that one. So, I mean, I can really relate to exactly what you guys went through with that property. And it's the truth. There's a ton of opportunity in those. I mean, that's a very distressed deal, right? I mean, there's multiple components of distress in a deal like that. And when you get into a deal like that, in fact, if it's your first deal, you don't know. But what happens a lot of times, you get in there and you think that you're going to convert the weekly renters to the monthlies, and you end up losing a bunch because really it's a different mentality that exists in a person that rents weekly than someone that actually wants a long-term type lease agreement in place that pays on a monthly basis. In fact, maybe you guys had a different experience, but in mobile home parks, we've never had much of a good luck actually converting weekly renters into monthlies because they literally do not know how to budget their money. That's why they live in a weekly rental. They
all end up busting out.
Yeah. They do bust out. They literally don't know how to save their money from one week to the next to add it up to where they can actually afford to pay the rent at the beginning of the month. And so, I want to talk to you a little bit about some of those components in there of the value add that you saw, Gino, and the things that got you excited. So these were, number one, they were a lot of mixed individual cottages. You said some duplexes here and there that made up the 25 units. You had mentioned that the cable expense was included. She said all the utilities were actually included. So they paid one rent payment, and that included water, sewer, electric, cable. Mm-hmm. Is that true? Everything was included in there?
Their mentality was, as long as that we can keep the heat on for them and put a television on, that they're going to get their pizza on Fridays and pay us they're $175. Mm-hmm. And then the rest of that was it. That was what they were basically saying.
I would have to guess, because you guys, we all know that when you've got those types of renters and you're including the water and sewer, there's no conservation there, right? I mean, nope. that gets out of control very quickly. I mean, typically double and triple what it should be if they were actually paying for it. And so I'm guessing that the owners that you purchased this from, they probably weren't really making much money on this deal. Now, they probably didn't owe any money on it, and so they were making a little bit each month. But I'm guessing that when you took this over, based on your new debt service, you guys probably had a few tough months to where you were probably just breaking even, maybe even losing some money, or maybe making just a little bit, but you weren't killing it from the get-go, and you had to put a lot of your systems.
What happened with us was, it makes me sad to think that a tenant can pay $175 a week, and at the end of the month, what is that? That's $350. That's like $700 for the month. But then when you tell them I give $600 a month, you give them a break for the month, and they can't make that equation where, like you said, they can't budget. It kills me. So we actually had to reposition most of the tenants, and we didn't do it all in one shot. You just take a couple at a time. So we had a 6+. Mm-hmm. So we did it sporadically. We didn't want to get we didn't want to have 100% vacancy. So we did it sporadically, and it was a slow learning curve. We had the things were furnished, so we had bed bugs there. So one of the guys actually ended up suing us for bed bugs that were his bed. That was his bed. It wasn't even our furniture. You know what I'm saying? So I mean, everything that could go wrong went wrong on the property. But remember one thing: we bought it right. We bought it with great numbers. It was generating a lot of income, and like I said, we cut out a lot of that fat. A lot of that fat we were able to save. So the other thing, what happened, Jake? But the septic fields, they failed.
We ended up replacing all the septics.
Oh my gosh.
Yeah. Basically, and the thing is, we've even to this point, we've replaced all the roofs on it. We've shored everything up. We're going through this huge painting process with it now. And the beautiful thing about this property is we've really never had to come out of pocket. We've been able to cash flow on it enough because we bought it right, and there's enough cash flow from the beginning. Okay. And then we refied it too, and I think we took out $180,000 on it to help do all the roofs and things like that. And we didn't have to use the whole 180 to fix the place up, so we were able to reinvest some of that into future deals, and the thing still cash flows like $3,000 a month for us. It's
that's beautiful. That's a beautiful.
We took our lumps. We took our lumps with it so hard in the beginning, but it was so worth it because we learned the business from the ground up, and we saw what like the hardest version of the business can be. And so you learn from there, and then you start to get things that are a little bit better and make your life easier, get better folks in place, and it catapulted us. So it was worth it, every little bit of it.
Yeah, Kevin, that was a great education. I mean, literally, you guys went to college on that property.
Yeah.
Yep, one of the hard things about it was we didn't have a team in place. It was our first deal, so we didn't have a resident manager. We didn't have contractors. We didn't have plumbers. We didn't have any of these team members. We didn't have any kind of software to run. So it was different. That was the hardest thing about it, I think. Our first deal, we didn't have anybody we could lean on. We took the property over, and they actually repaired a couple of roofs and did work because we didn't have contractors at the time. So we were running blind the first deal. But that's what happens. We went through a couple of resident managers in the very beginning. Then we finally found one, and the guy we found, he's actually running one of our other properties. So in the very beginning, it's difficult to start because you don't have team members and you don't know what you're doing. But like I keep saying, my should was so powerful, it became my must. My must. I said, you know what? Even this property, I don't care. I'm gonna make it work. And the worst thing that could have happened is if this didn't work, we could probably sell the property at a profit. The way the market was emerging and all. So sure. I mean, what's the worst thing that could happen? Even if we lost 20 or 30 grand, not the end of the world. But at least in life, you got to try. If you don't try, I don't want to have that thing 5 years from now saying I should have done that, I should have bought that. I don't want to be a shoulda person. I want to be a musta, and if I fail, I fail. But I want to at least fail trying.
So there's a Walmart going up next door to the thing now, and
that's beautiful.
We basically shored up all the buildings, and we have it looking much better. So if we got an appraisal now on it, I think we'd probably come in easily $300,000 more than what we paid for it.
Yeah, so let's talk about that a little bit. I want to hear the numbers because that way we can really understand this entire property and how this thing transitioned. give us kind of the basics of your acquisition price, what type of financing, what kind of terms you got put in place there on the owner financing, and then give us kind of a picture. I know you did a cash out refi, but give us a picture of what that property looks like today, what kind of debt you got in place, and you already told us a little bit about the cash flow, but give us an idea what like your cash on cash returns on a yearly basis look like, just so again we can better understand the actual mechanics of the property and what it's looking like on an operational basis.
Well, our cash on cash returns now are infinite because we have no money in the
You got
deal,
all your cash out, right?
Yeah, we got all our cash out, and then we were able to repurpose some of it.
Isn't that a nice feeling?
That's a good feeling. We like that. But yeah, I think we paid $600 for it, Gino. Was that what we paid initially?
We paid $600,000. We put 10% down, so it's $27,000 for me, my brother, and Jake. So $27,000 with closing costs. The bank held, the owners held 10%. the note I think was for 5.5%. So I mean, at the time,
No, I think it was 6 actually.
Yeah.
We get kind of clobbered on that one.
Yeah, it was the first one. We didn't know, you know what I'm saying? But we took the chance. The bank's terms were pretty crappy too. We got a 20-year term.
Oh, I'm sorry. Yeah, I was talking about the bank's terms. I'm sorry.
Yeah, the bank was like 5.5%. When rates were around 4.25%, 4.5%, it was a 20-year amort, which we hate. You got to get at least 25 years.
Yeah.
But you know what? What happened when we refied it at 25 years at 4.25%. So our actual payments stayed the same even with that much higher mortgage amount. So that's the crazy thing about it. So, you know, people are going to say, oh, you made a mistake with the terms. I mean, I'm glad we did it, you know, looking back, but it gave us a lot of insight as to, listen, we have to make banks compete for our business. We were just so thrilled to get into this deal, and one of the reasons why we used this bank was the lady was using it, so they knew all the numbers, they knew the deal worked. It might have been harder to get financing elsewhere, so that's why we use these guys. And you know, after we did the refi, we were going to actually pay her off, but she said, you know what, I don't want to get paid. Just give me another $10,000. So her note was for $60,000. So we gave her another $10,000 last year. We extended the term another 5 years. So I mean, we're
5
still
years on top of the 5 that we had. So it's actually, we got like 9 years left to pay it off or something right now.
Yeah. So I'm going to wait. I told Jake in 2 or 3 years, we're going to wait till Christmas time. We're probably going to have $40,000 left in the note. We'll say to her, hey, listen, you want $25,000 for Christmas? We'll pay off the note. We'll see if she takes it. She might take it. She might not. Yep. But it's just, I mean, the whole thing worked for us. So what ended up happening was we were really able to, the income did not go up that much. It might have gone up maybe $1,000 or $1,500 a month, but the expenses got drastically cut, and that's what happened with our NOI. Our NOI really burgeoned. So at the end of the year, when you got a much higher NOI, bank sees that. Also, the ability that the bank sees the progression of what happened on the property, as far as the tenant repositions, as far as the deferred maintenance is gone. That gives a lot of value to the property. Also, that's why we were able to cash out. And like Jake said, we took out $180,000, but we were able to allocate maybe, let's say, $40,000 back into the property. So we actually pulled out our capital, and on top of that, we probably have an extra $30,000 or $40,000 each that we were able to repurpose it into the next deal.
Mm-hmm. Okay, so you guys basically have all your money out of the deal. You still cash flow each and every month. And today, conservatively speaking, what do you think that property, if you sold it today, you put it on the market for like a realistic price that would actually sell in a reasonable amount of time, what do you think this property would sell for in today's market?
We'd have to put up for at least 900, right? Okay.
Yeah, I would say between $35,000 to $40,000 a unit. That's what they're going for right now. And like Jake said, it's on a major highway. We like it because it's in a submarket, so we're paying less property taxes. We're paying a lower insurance, so the expenses are lower. We're not in Knoxville proper. We're in Maryville, so it's I think a better market as far as expenses go. And like Jake said, there's a Walmart going up the street, and it's easy. It's so simple to rent because it's right on the main drag, and there's a huge demand. We haven't had any vacancy there.
People love the cottages. They love them.
Sure.
So
yeah, like you said, I mean, it's very
house.
similar to mobile home parks. I mean, I always say, like, our comparison with mobile home parks is the options, at least the type of parks. We own family style parks. I mean, they're good, hardworking, blue collar individuals that live in our communities. I mean, we call it clean, safe, and quiet living, right? Good places to raise your family. And so the options that the people that live in our parks have is based on the income that they make for their family would be to live in more like a C-grade apartment building, so something kind of lower grade apartment building to where they've got neighbors above, below, and side by side. They don't necessarily have their own parking spot. Or they can live in their own mobile home where they can put Christmas lights out. They can pull right up. They've got their own parking pad. They can, put a shed out back if they so choose to. They've got their own little yard where they can have cookouts and things like that. And so those are the options that they have. And when someone in that price bracket, if they know that they actually have those options, a lot of people have never really even considered living in a mobile home, right? And so they don't even know if it's an option. But when they realize that they can literally own the mobile home, live in a community, have their own place for the same price of living in a low-grade apartment building, then typically they choose that mobile home. And so I get it. I truly agree with you on that whole cottage feel. They'd like to have their own space.
It's so funny because when we took our banker out there, the guy that we work with now, he's walking around, he's saying, this is like a souped up mobile home park. That's exactly what he said to me. So I was like, yeah, a little bit.
So I want to ask you guys, Gino, so you were living in Knoxville at that point in time. Do you think you guys would have bought that property if Gino wasn't there, if you didn't live nearby? Do you think you'd have still done that property?
Well, no. So I was living. This is Jake. I was living in Knoxville. Gino is still in New York. So no, it would have been no. I don't think that property.
That's right. Gino, you're in Jacksonville, right? Jake, you're
He's in Jacksonville now. Yeah.
Yep. Gotcha. Yeah. Sorry to confuse you guys.
No. It's all right. It's just I think that the bigger stuff that we've done, if we wanted to, like the 150, 300 unit stuff that we've done now, if we wanted to put that under management, like real just property management companies and do it out of state, we could do that. But the little stuff, like 25 unit stuff like that, I think it would be very difficult for us to do it from out of state. And also that's actually a lot of the opportunities we've bought from people from California who tried to do like a 25 unit.
Yep.
And just we're having too many issues being out of state. So I think the bigger stuff, yes. The smaller stuff probably be a little more challenging.
Yep, I agree with you. Okay, so I want to talk about that because you guys went from that 25 unit, and in again a short period of time, just a few years, you guys have amassed 675 units in total in your portfolio. And so most recently, you guys closed on was it 150 unit property?
Yeah, it's 156 units.
156 units. Is that the largest one in your portfolio at this point in time?
We did a 281 unit deal, but it was there was multiple parcels. So this is the most units we have on a single parcel.
Okay. So I want to talk about that a little bit because you had mentioned, maybe that first deal that you had done, if it was bigger in size, you've gotten third-party management in place, that it could have made sense to do from afar, being a distance away. Mm-hmm. Now, these larger properties that you're buying, are you guys actually involving third-party property management companies, or are you utilizing your own on-site property management and kind of running the management show?
Yeah, we've just built out our teams, and so as we've gone on, we've just scaled up, put systems in place, got property management software, online payments, websites. We've really built out an entire business, for our company, for our investment business. So we have I think 13, 14 employees now. We have a ton of subcontractors that we use. Obviously, if we need higher level plumbing stuff, we have it all in house now, in the software and everything that we need to run the business. Just a great tip for everybody out there. There's a book called Traction by Gino Wickman, and I just use that. I read that at Audible. Go back and look at it a ton because it's a great way to build out and systematize your business, especially for if you're managing your own property.
Okay. And so do you guys manage other properties as well, or just your own?
No, just our own stuff.
Okay. Do you find that is that a profitable side of your business, or is it just kind of like a break even at this point in time? And I only ask that question because interviewing other guests on the show, everyone's got a different take on it, right? I interview guys that have portfolios of 10,000 units that either they outsource everything to a third-party property management company because they feel like there's not a lot of profit to be had, or it's not worth the headache to actually have your own internal management. And then I've got the other perspective, which is, no, we handle everything in-house, and we started doing that at 2,000 units, and we've managed everything since that point in time because at that point we felt it made more sense to bring it back in, and we actually had we created our own profit margin there on the management side. So do you guys find that is it a profit center for you at this point in time, or is it just a break even and just allows you to have a little more control?
No, it's definitely it's a few things. I think it enables us to be more hands-on. Out of the 600 and we have 674 units actually, and we have currently 4 vacancies. Okay,
oh my gosh.
So I think it's enabled us to not only really drive the income in a lot of instances and be super hands-on. And I've always been in sales, right? So I've had really good sales managers, and so I'm very much on top of our managers, driving the vacancies and making sure the rent increases are going into place. So a lot of examples. I'll give you just two examples. On 136 units we went from $50,000 a month. Last few months we've been averaging over $90,000 a month. So we've done a really good job at repositioning our properties. On the 281 units, they were doing $140 a month. We just did $180 last month. So it's very much hands-on, treating it as a business and driving the income, while at the same time keeping the expenses be down and constantly reviewing contracts and cutting the fat. Mm-hmm. So that's been a huge part to our business because if someone else is doing it, are they going to have the same care and attention to detail as you? I don't know, maybe, but we just bought the 156 units from the premier property management company. They're owner investors in Tennessee, And this property was probably doing about 100 a month, and we just did 112 last month after owning it for 3 months. So I do think, yes, it's a profit center for us, and yes, it gives us more control, and I think it works for us. Is it for everybody? I don't know. It's just it works for us.
No, I feel you. I mean, it works for us as well. Yeah. I mean, we don't outsource any of our management. There's some other reasons behind that, at least in the mobile home park space. We don't have as many options for third-party management companies in the space that you do in the apartment space. But in any event, I feel like we have the systems in place, and I feel good at the end of the day or at the end of the month knowing that we've done everything in our power to make the most that we possibly can of our properties. I mean, I know that
we want to maximize. Yeah, we expect
no stone goes unturned. I mean, we don't have a day that doesn't go by that there's not an ad out there on Craigslist or multiple ads out there on Craigslist that are being updated on a regular basis, and that we've got the best pictures for our properties and that they're being represented in the best manner. So, no, I agree with you on that one. Okay,
Kevin, the only tip I would give the listeners out there is if you're going to get into the business, at least the first or second property, try to self-manage it yourself. Try to learn the business yourself. So when you go hire a management company, you know exactly what to expect. You've already learned the business from the ground up. So when you go hire somebody, you know what to tell them, you know what to look at, you know what an income statement looks like, you know how to do a tenant eviction, so you can teach them systems. I think what we wanted to do was learn the business and try to make it almost like a franchisable model. So when I come down here in Jacksonville, I just say to Jake, hey Jake, how do I replicate the system down here, and how do I give it to a management company down here? That's what I think our end goal was. But seeing how well we manage the properties and the ability to scale up. That's why these big properties give you the ability to do. It's the ability to scale up and to hire competent and good people so you can pay them to help you run the business. That's one of the reasons what's been successful for us.
Do you guys think there's an opportunity in actually managing other parties' properties for them, with the idea that down the road when that property might become available for sale, that you get first dibs at it? Is there an opportunity with that?
We haven't thought about it, but I think there's a tremendous opportunity because I see the prices here in Jacksonville. Everyone's talking about compressing cap rates. The prices here are tough. There's a lot of guys that want to get out, a lot of guys that mismanage. So if you get into a property, the only caveat is our problem is we'll probably crank on the property. The property will be too expensive to buy.
You're gonna increase the value of the property, and
right?
I just want to focus on our business. We're doing it for ourselves,
sure.
and realistically, one of the hardest. It comes down to three things: buying right, managing right, and financing right. And the managing portion of it is probably, we were talking about this before the call about, we don't have really outside investors that we use because it's, we felt like we didn't really necessarily want to deal with extra folks at this point. And it's the management end of it. You have a lot of folks to deal with, a lot of personalities that you have to manage. So I like doing it when it's our own stuff, but if it was someone else's, it almost then, do I want to do that? I don't know. I don't know the answer to that. I don't know for us that it's the right move at this point.
Yeah, I mean, you guys talk about lifestyle a lot, and I feel like lifestyle is the reason why we do this business. It's the reason why you guys are buying apartment buildings. It's the reason why we're buying mobile home parks. And I know you guys both have families. You're both married. I am as well. And, there's something about having free time. I mean, you don't need to own and manage. Like some people have the personality that they just want to control the world, and they want to have 20,000 units. They want to, be the biggest in the space, right? That's not how I do things. I mean, and there's nothing wrong with that. It's just a personality trait. That's all. But there's something that goes along with lifestyle and actually having the time to spend with your family, to travel when you want, and to not have added stress just because you want added stress, right? And I feel like the management side of the business would add just that component to you. I mean, it would add that level of stress that isn't necessary. You guys are making plenty of money by owning your own properties. You've got great systems in place. Why not focus on what you're great at? And that's buying your own properties and managing your own properties. Why even try to add the other component in? Even if it can make more money for you, is it going to change your lifestyle for the better? And probably not.
I think it would be more headache than value for us to do it. And I don't necessarily, I'm not interested in it at this point. So
yeah, it sounds good. Well, I want to talk to you guys a little bit about how you're finding your deals, because I know that a lot of the properties you've purchased, you guys really stress the idea of dealing with mom and pops, and kind of the same thing that we do in the mobile home park space. And so I want to talk to you a little bit about how you guys actually find your deals. I know you're buying a lot in the Tennessee market. I don't know if that's where all your portfolio is or not, but do you guys solely utilize brokers, or do you do some of your own direct marketing as well to find these deals?
Well, it's funny, when we were speaking to you a few weeks ago, I was like, oh man, he's cranking it out there with the mailers and everything. I was like, that's a great idea, because we've really just leveraged everything through relationships. We found some stuff that's been on LoopNet for a few years. We've been able to get it like that, and it's just knowing all the major players in our market. There's, I always say there's a handful of brokers in the area that are really dealing with the multifamily, and we've developed really good relationships with these folks. Talked to them about, this is specifically what we're looking for. We like larger properties owned by families with siblings. Maybe they've inherited it, or it's whoever it may be. It's just these mom and pop run businesses that own larger multifamily portfolios is what we're looking for, and we've got it out there to the people that are basically listing this stuff, and they've been able to bring it to us to date. So we haven't done much marketing for properties.
Do you think a lot of the
a lot of the brokers down here are buyers brokers. So when you're actually listing a property, a lot of stuff doesn't hit MLS. So there are a lot of calls to offer down here. So if you don't have a relationship with a broker, you're not going to get a call saying, hey, I've got 156 units in Knoxville. This will be ideal for you. We just got a call like that a couple weeks ago. The guy actually called it a mom and pop, and he had sold us 156 units. So he knew our wheelhouse. He knew we could close. He knew what we wanted, and he brought us the deal. Unfortunately, it's way overpriced, but we would never have seen that deal if he didn't, send it over to us. So you've got to get out there and make, definitely make those networking opportunities with those brokers, because like Jake said, it's Pareto's law. It's the 80-20. 20% of the brokers control 80% of the listings. You have to find the 20% out there, and that's what I think drives multifamily. You have to make the relationships. You have to make sure that you have credibility. When they bring you a deal, if the deal doesn't fit your parameters, tell them why. Say it's not cash flowing at 10%. I don't like the debt coverage ratio on it. I don't like the cap rate. And they say, okay, at least they'll respect you for that. They'll know exactly what you're looking for. So when something does come up and pings on their radar, they're going to come right to you and show it to you.
You hit such an important point there that I just want to clarify, is that if you're going to go out there and start building relationships with these brokers, if they start sending you deals, even if it's a crap deal, and I feel like a lot of brokers will test you. I mean, if you're brand new and that relationship's new, they're going to send you some crap more than likely. They're going to send you that listing that's been passed around for the last 6 months, and it's either overpriced or there's some just underlying inherent problems with the deal, which is why it hasn't necessarily sold. And a lot of times it's a test. They want to see if you're going to actually take the time to go through and underwrite the deal and give them feedback on it. And if you're not, if you're just going to look at it and delete it out of your inbox and not even give them the respect to call them or email them back and let them know why that you might not be interested, then slim chance that you're going to get any more deals from that broker. Would you guys agree with that?
Right. I totally agree with that. I went out about 3 weeks ago down here, and their brokers were bringing me some deals, and the couple deals they brought me, I'm getting familiar with the market, but I knew right away, when the broker says he's underwriting the deal, I'm saying to myself, how could this guy underwrite the deal? Give me the numbers. That's my job to underwrite the deal. So he's underwriting at a pro forma. So right away I start talking to lingo, and I look at him, and he knows exactly that I know what I'm talking about. So he's like, oh, and we're at the property. So he takes me to the property. So I'm saying to him, we can do the clubhouse, we can do the fitness center. I'm giving him every value add, and I can see the light bulb going on in this guy's head. And I'm saying to myself, I should just shut up, because I'm giving this guy all this. But at the same time, I'm building the relationship with him and telling him that I know what I'm talking about and what my parameters are, what I look for as far as value add components. So maybe the next deal that comes by, he might think of me and say, hey, listen, this is a good deal for Gino. Gino might make some money on this deal.
Yeah, so, they just want to know that you're not going to waste their time. Brokers only make money when they sell deals, and so they only have so many hours in a day, and they only want to work with clients that they know can execute and actually close on a deal. Otherwise, they don't get paid, and their time's wasted. Right. So
I beat that drum, by the way. I beat that drum. I'm like, look, we get it done, and I give references. Here's our title company. Here's our banker. I'm like, we're closers. We get it done, and that's honestly, in this market, especially where it's super competitive, brokers want to go with someone that's going to get it done. Obviously, they want to get the highest price for their client, but they need to know that you're a closer and you're going to knock it out. So that, I think, is just something that's invaluable, and it's really helped us out, is just getting in there saying, and we're selling these guys and why we're the group to take it down. So.
And Kevin, there's one thing that Jake and I put together. We have something called a credibility book. It's basically a business plan that we put together with our parameters on why we invest, what we invest in. And it's funny because all our deals are basically mom and pop, and one particular area, whether it's a motivated seller, a distressed property, an older property, a tenant situation. So we have this credibility book. It lists all our case studies. It lists how we bought the property, whether it was owner financing, creative financing. It lists what we did to the property, and it lists all the value adds. And then it shows our refinancing strategy and all that in this book. So Jake likes to go into a banker or a broker and throw it down on the table because nobody has this, right? Nobody's prepared. Nobody's willing to take a whole day worth of their time, put this book together, and actually have it. So when you go make a relationship with a broker, you give it to them. I mean, a picture's worth 1,000 words. We have our whole portfolio on there, so they can see exactly what we have, what we own, and it just makes us look really credible. I mean, you go to a banker, trying to start a relationship with a banker, you throw it on the table. I mean, what can he say? It's all in front of him, right in front of him.
No, absolutely. I think that's a great idea. Do you have that available? Is that only on your website, or is that something that you keep proprietary for yourself?
No, we actually have there's a course on Udemy actually that we're selling it at, and we actually have our credibility book on our website also. So if you want to take a look at it, download it and just start building one out, just like we have. I mean, we basically PowerPoint. We did it professionally designed, but we started out with a PowerPoint presentation and we filled it out. And what's great about it is it gives you an idea and it makes you focus on your niche. It makes you focus on what you want to invest in. So that's what happened with us. We started with our apartments, but then we really niched it down even further to mom and pops, to value adds, to creative financing, to motivated sellers. It's so weird how a lot of our deals encapsulate all those areas. And when you become niche specific and you can target, you're going to hit more. You can hit more targets because you're going to be able to actually find the stuff because it's going to find you, believe it or not.
Well, then you're not going to waste your time on the things that don't fit your targets either.
That's right.
Totally. And I feel like that's one of the challenges that a lot of newbies run into is like they're all over the place. I mean, they're basically saying, I buy multifamily. Okay, well, what does that mean? Oh, just send me an opportunity and I'll take a look at it.
They buy multifamily, they fix and flip, they do mobile, they do everything, and they want to do everything, but it's just they want to be investors, but they just need to get specific on it.
Yeah, I mean, I know that is one of my weaknesses is that I chase the shiny object, right? I mean, it's just I'm an entrepreneur by nature, and that's just how my brain works. But I know that that's one of my weaknesses, and so many years ago, probably at least 10 or so years ago, I realized that I need to be focusing in my real estate business. I need to be focusing on one thing and be the best at it. Initially it was single family homes. We had a big portfolio of single family homes. Then we started buying smaller apartment units, and now it's mobile home parks, and that's all we buy today. Now that doesn't mean that I wouldn't invest. If someone brought me an apartment deal, if you guys came to me and said, "Hey, Kevin, we're looking for a partner on this thing. It's a great opportunity. Here's why," I would absolutely take a look at it. But I'm not out there prospecting for apartments because mobile home parks, that's my space. That's what I feel like I'm an expert in, and that's what I love. And I really only have time to be an expert at one thing. I don't want my focus to be diluted by looking at office buildings and shopping centers and apartment deals, because that means that all the time I spend looking at those other things, I probably missed an opportunity right in the mobile home park space, which is what I'm the expert at, right? Because I was spreading my focus thin on all these other asset types. So I think that is a challenge that a lot of newbies go through. So if I can give you guys any advice, those that are listening in, and I'm sure you guys will agree with me, is that figure out what you want to do, what you want to own and operate, and just become the expert at it. Take the time, take the energy, and just become the best you can be in that particular niche.
There's enough real estate to make money on it, that's for sure, depending on whatever you want to do. So it's not like you're not going to be able to find opportunities.
I want to ask you guys it's a question I like to ask all of our guests that we have on the show, and you guys can answer it individually, collectively, but you've been in this business now, I guess 5-6 years. Is that a fair statement of when you guys?
Gino's been in real estate for a while. I mean, the
multifamily space, like from the apartment side.
Yeah, about 5 years.
Okay,
yeah.
So you guys, but you've done a lot in that 5 years, and you've learned a lot. You've gone through a lot of challenges, have a lot of lessons from those challenges. If you could go back to year one, so 5 or 6 years ago, and knowing what you know today, give yourself some advice. What would that advice be?
Jake, let me take this first, Jake, because I've got a decent sized list. I think the first thing is
kick back, folks.
I've made a lot more mistakes than Jake. So first thing is you have to learn your market. You have to know what a price per unit is. You have to know what expenses are. You have to know what the job growth is. You have to know the dynamics of the market. You have to know the demographics of the market. You just have to know your market. Now, do you have to live in your market? No. You can go on Google, BLS.gov, census.gov, Google the name of the city. You have to know it. You have to know the submarkets. You have to know what's going on. If you don't, trust me, you're going to get burned like I did. There's no two ways about it. Learn the market. Learn what's going on. You want to invest in an emerging market with job growth. Everything else, forget about it, because it's going to take a long time for you to make money in the deal. Unless you're living in it's your backyard, it's a different story, but learn the market. The second thing is make it a business. Don't run it like a hobby. Don't run it like a charity. I mean, I've been bantering back and forth with someone on Bigger Pockets. She's talking about it as it's not a business, it's not market driven. It is market driven and it is business specific, and you're in it to make money. And you had said before something about, we call it modern affordability. What's awesome about us is the more value you create, the more people you serve, the more money you're going to make. So that's what's the greatest thing about business, is the more money you can make because you're serving more people. We love the modern affordability. So we're in it to make money, and we're in it to give people a nice, safe place to live. And number 3 is focus on the numbers. Don't fall in love with the property like I did. I've done that a lot of times. Fall in love with the numbers, then you can fall in love with the property. Because if the property is not cash flowing positively, don't even consider it. I don't care what happens a year or 18 months from now. Appreciation is icing on the cake. We're able to force the appreciation. We don't have market forces doing it. We're forcing the NOI up. That's what's great about mobile homes and multifamily. We're not looking at comps down the street where a 3-bedroom, 2-bath is. That's why single family stinks, in my opinion, because it's all market driven. If you get in at the right time 4 or 5 years ago when the REITs were buying them up, that's great. But now that party's starting to end, and you're looking what the guy next door is selling it for. It's not NOI driven. You can really take control with multi and mobile home and that kind of space, and commercial, because you can drive the appreciation. We focus on the numbers. We focus on the 10% cash on cash and 8 caps and B and C properties, and then we let our magic go. We get to work and we can force that appreciation. So focus on the numbers.
You know, I want to dig into one of the points you just made there, Gino, is about single family homes versus multifamily, how you force appreciation, and how really the single family properties are only worth what the neighbor property sold for, right? Whatever the comparable sales approach would say it's worth. And that's the thing that drives me crazy about this whole turnkey business, that really has come out of nowhere. I don't remember that business model ever being around back before the recession. And I feel like we owned a ton of single family properties. We were in the business big time here on the west coast of Florida. And I don't remember ever hearing anything about the turnkey model. I'm sure it existed somewhere, but it wasn't as big as it is today. And I see these guys selling these single family properties based on an income approach. And, people are paying. I mean, they now they might have cash flow. They might realistically cash flow. But I see a lot of them have inflated rental amounts. They're kind of pushed to the brink of, at some point, if there is a correction, they're probably going to get, they're going to get hit slightly, maybe 10 or 15%, and they're going to drop down. And now there might not be no return in that property. But in any event, I see them being sold for basically retail prices because they're selling them an income approach. And that means if there is any kind of correction in the marketplace, I mean, what's your exit? Typically on a single family home, your exit really is going to go to an owner occupant more than likely. That makes up about 90% of who your end buyer might be. And the other 10% would be a potential investor that's going to buy it for the cash flow, as you did, right? And so you really have to look at it from both standpoints. I mean, if you're buying a turnkey property, you really need to put more weight on what is it valued at today from a comparative sales approach. Forget about the income side initially, because really you need to know what your exit is. You always got to have an exit when you get into something. And if you don't know how the heck you're going to get out of it, should things change in the marketplace, then you might be stuck with a dud. You might be stuck with something that's going to be an albatross around your neck later on down the road.
I agree with that, Kevin. I totally agree. And the other problem with that is you've got to amass so many of them to spread your risk, right? Many. So why would you buy 20 houses when you can buy a 25-unit apartment complex? I always tell this to Jake, do one closing instead of 20 closings. Yep. It's a lot less headache. You have everybody in one place. I mean, the turnkeys were great 5-6 years ago when you were buying them at 60, 70 cents on the dollar. But now you've got to have a lot. And like I always tell Jake too, you have one vacancy. People always underwrite it with like 10% vacancy. It's not true. When you have a month's vacancy, you've got to pay a month to lease it up and you lose a month's rent. Yep. So there goes your cash flow for the next 2 years. Nobody ever talks about that.
I know.
And the quality of the tenant is the same as in our apartments, because there are people that are getting into these $40,000, $50,000, $60,000 homes that can't afford to buy them. So they're renting them out, and maybe they might stay a little bit longer, but our tenants stay a long time because we have the model where we take care of them and we have great customer service. So people in C properties tend to stay longer because they can't afford to buy a home. So if you take care of them, they're going to stay in our properties as opposed to those single families. So there's so many flaws in that market, but it's simple. It's like buying a mutual fund. Anybody can buy a turnkey property, try to get 10%, and it's low level financial intelligence. That's what I love.
You just hit the nail on the head, though. The nail on the head, because it's the attainability factor, where people think, oh, it's a house, I can buy it. I bought a house before. And that's, I think, from the investor side, why people are getting kind of, sucked into these investments, because they just think, well, I can do it. It's easy.
It's easy.
Right? They've done.
Right.
Yep.
Yeah. I mean, people have a mental hurdle about commercial real estate in terms of financing. And so I think you hit the nail on the head right there. It really is. It seems easy. It's turnkey. Everything's done for them already. And a lot of them don't really critique the numbers. And so if a turnkey, if they got a financial model in front of their face saying, hey, this property is going to give you a 14% cash on cash return based on the financing that's available, they're like, oh, heck, gosh, that's incredible. They never really critique the numbers. Like you had said, Gino, you have one turn in a year in a single family home, and a normal turn would mean you've got to go in hoping that you don't have to replace the carpets or the flooring, which you probably actually have to replace some of it, especially in these lower end type rentals. If you're dealing with a $50,000 or $60,000 home, it's not the best grade of tenant that you have there. And so, I mean, you're going to have to go and you're going to have to repaint the entire home more than likely. And if it's a 1,200 square foot home, you're going to put probably some flooring in it. You're going to have to do some other minor repairs. You're going to have 2 months of vacancy, hopefully not more. You're talking thousands of dollars. You're talking $3,000-$4,000 for a turn. And if your monthly cash flow was $300 a month, which is really good, I mean, net cash flow, well, it just got eaten up in that one turn. And I had that experience because I was doing the Rochester thing. So I was buying duplexes. I bought a duplex for $31,000, had to put $7,000 into it. So it was $40,000 net. So $20,000 per unit. I was getting $600 a month in rent. It's great. When the renters are there, Section 8, they pay. But the problem is once they vacate, you've got to put $2,000 or $3,000 into that property and you lose it. Like you said, you lose that month's rent. Plus you've got to pay the leasing agent the $600. Yep.
So, when that property's humming along, it is doing fantastic. But as soon as as soon as you get the eviction going, they don't pay for the eviction, and it becomes a nightmare. It really does. And then the only caveat to that is if you have 60 or 70 of these where you can bundle them and sell them off as one big portfolio, that's what a lot of guys do. So I mean that makes sense, but at the same time, it's hard to manage 60, 70 houses all over the place. It's really difficult.
I've done it. Jake, it's very challenging.
Jake talks about we have 150 units. We might have 2 maintenance guys, but if you had 150 homes, how many maintenance guys do you need? Be driving around with gas, having cars all over the place is a lot of risk going on. So I think under one roof, it's a lot easier and it's a lot simpler to manage.
Yeah, I mean,
you guys just got me my next Snapchat. You ready?
Yes.
So in my experience, easy doesn't equal a great investment. Problem solving does. Boom, going up today. Just saying.
Love it. Aren't you too old to be on Snapchat?
I think so.
Listen, man, you gotta. This is for all business, and this is my next Snapchat after that. If you're not innovating, you're dying. Okay, if I gotta young up. All right, I gotta get younger.
I think my little niece she might see your post on Snapchat.
Tell her to follow me, Jake and Gino. Only if she's investing though. Okay,
that's funny. Well, good deal, guys. Well, hey, we're gonna enter into our Golden Nugget segment now. And here's what I'd like to do in this Golden Nugget segment. And again, you guys can collectively answer this. You can answer it individually. And what I'd like for you to do is, you've given us already a ton of golden nuggets today on the show. We've had a great conversation, shared a lot of incredible information. But if you could leave just one last final golden nugget of advice or wisdom that may inspire and motivate our listeners as they progress in their real estate investing career, what would that one last final golden nugget be? I'll jump into this and I'll just say suck it up, because it may sound a little harsh, but if you want to propel to the next level, if you want to thrust and create wealth for yourself, and you're currently working, you sometimes just got to suck it up, put your head down and grind, and get out there, like I said before, educate yourself and then take action and to make it happen. So. Okay. I love it. I mean, really, suck it up. I would equate that to like get uncomfortable. Get outside of your comfort zone. If you're not uncomfortable in this business and you're just getting started, then you're not progressing. You need to feel uncomfortable and uneasy probably at least 3 or 4 times a day, if not more than that. I still feel that way. I still get in situations where I get uneasy, whether it's we might be losing a deal or.
But you're growing then, though.
Yeah, absolutely.
Getting comfortable, being uncomfortable is when you're growing.
Absolutely.
I get excited actually now when, because we're looking at a deal and we're kind of getting capped out with this one banker, so I'm going to have to go out and make another relationship and figure out how to get good terms all over again. And I'm like, this is growing. This is getting out of my comfort zone, and I know good things happen when I start feeling like this.
Mm-hmm. All right, fantastic. Well, Jake and Gino, this has been a pleasure speaking with you guys today. Is there any last parting words that you'd like to leave with our listeners before we say goodbye for the day?
You got to come check us out, right? You guys, jakeandgino.com.
Yeah. I was going to say that. I was going to let them know where they're going to find you guys. Yeah.
Gino's the man of wisdom. Gino, what do you got?
I think the only thing is, guys, just try to read a book a week. Might sound crazy.
How's that possible?
read a book a week for the next 52 weeks. And I mean, you'll be amazed at what happens. And try to read good stuff, guys. Zig Ziglar, Tony Robbins. I mean, there's so many guys out there that you got to read and start putting positive stuff into your mind, because whatever you put into your mind happens. Your subconscious is so powerful. You act upon your thoughts. Is it tough out there? It's really tough out there. It can be really tough out there dealing with people, but you just got to continue to grow, continue to push yourself, continue to ask those empowering questions. What's going on? Why is this happening? Just think, and you know what? You can do it. Trust me. If you put your mind to it, you guys can do it.
Yeah, here's the thing. I mean, we're in a very challenging market at this point in time. I mean, deals are few and far between. You've got to look at a lot of deals to find those golden nuggets. And if you can learn how to successfully invest in a market like we're in today, whether it be apartments, mobile home parks, or whatever else you're investing in, then when the time comes when there might be some kind of slight correction, which, we're in the longest real estate correction that we've ever been in. So at some point in time, for whatever reason, I don't know what's going to happen. It could be some type of a natural catastrophe that happens, like a 9/11. It could be financial markets crashing, stock market crash. There's so many different variables that might take place. Interest rates going up. But if you can learn to successfully invest in a market like we're in today and learn to find and uncover deals and build your network of brokers and build these relationships, then when things make a slight shift for the worse, you're going to be prepared. You're going to be, guns in hand, ready to go out there blazing, and you're going to be 10 steps ahead of anyone else. So,
Kevin, I got your answer, by the way.
And what's that? I
got your answer for you about how do you read a book a week?
Yeah. So, how is that? How's that even possible? Do you prop your eyes open while you're sleeping?
No. How many hours a week do you work out?
Probably about a week. I don't know, about 12 or so, something like that.
Man, you're a beast.
Right. That's not like gym time. Like I cycle a ton.
It out. Check it out, though. You put on the headphones, right? You get Audible on your iPhone. And you go with it. Most of these books are like 5 hours, right? So you should be doing 2 if you're working out that much.
I know. Here's my challenge with that is I do some really challenging cycling, and so I have a hard time some of those narrators are so monotone and boring that I have a hard time getting into the groove when I'm out there trying to get a good workout in if I've got some guy talking like this. You
gotta find your niche. You gotta find the guys that are pumped up, motivating. You gotta have Gino read to you.
And I used to listen to audiobooks all the time. I used to do a ton of driving, and now I just don't drive as much. And I find it very challenging for me to sit at my desk and have an audiobook playing. And so,
I agree with you. Working out.
Yeah, you got to do it working out. You're right. You're okay. Well, fair enough. You guys put me in my place on that one.
No. I'm finding solutions. We're problem solving here. Nothing like that.
No, I love it. Well, guys, this has been a lot of fun. And again, just to reiterate, for those that are out there listening, to learn more about Jake and Gino, you can go visit their website, jakeandgino.com. Again, that's jakeandgino.com. And that's all we have for today, guys. It's been a lot of fun. Looking forward to keeping in touch with you. I'd love to bring you back on the show at a future date and get some updates from you. Maybe we'll touch base in 6 months once you guys hit 1,200 units, because it seems like you're on track to make things happen.
I'm hoping to get there in the next 90 days. But Kevin, you are the man. We appreciate your time.
You guys are awesome. You can take care.
Thanks, Kevin.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.